Good morning. What the jobs reports means for mortgages. And every month, the jobs report moves mortgage rates, and sometimes within minutes. And if you're buying, refinancing, or investing in real estate, understanding how employment data affects mortgage rates can save or cost you thousands. And as a mortgage broker at Medallion Funds, I watch the jobs report closely because bond markets react immediately and mortgage rates follow bond yields and not headlines. So let's break this down a little more clearly. What is a jobs report? Well, the monthly jobs report, it's officially called the Employment Situation Report, is released by the U.S. Bureau of Labor Statistics. And what it does is it's going to measure non-farm payroll growth, but also the unemployment rate and what's happening with wages, whether they're growing or shrinking. And also your labor force participation, how many people are actually gainfully employed that want to be employed. And these numbers tell investors whether the economy is going to heat up or if it's going to cool down. And what that does is it directly affects mortgage rates and their demand. So why mortgage rates react to jobs data? And mortgage rates are heavily influenced by bond markets, particularly by mortgage-backed securities markets or MBS. And it's really pretty simple, but it's a big confusing concept. So let's jump in. If you get a strong jobs report, it means your economy is strong. And if you have inflation risk, bonds sell off and rates rise. Whereas you have a weak jobs report, you have a slowing economy and inflation's cooling and bonds rally, so rates fall. And the bond market is forward looking. And if wage growth spikes, investors anticipate inflation and higher rates often follow. So the three numbers that matter the most, first being non-farm payroll growth. If job growth significantly exceeds expectations, mortgage rates often increase quickly thereafter. Now, we have the unemployment rate, and a falling unemployment rate signals economic strength, which can actually pressure rates upward. Three is average hourly earnings. So wage growth is critical. And rising wages can drive inflation, and inflation is just the biggest enemy of low mortgage rates. So what does this mean for you as a home buyer? Now, if you're shopping for a home, a strong jobs report can increase your payment before you lock. So that's one reason. But a weaker than expected jobs report can create short-term rate improvements, which will help your payment. And volatility often happens the morning of the release, and there's usually a knee-jerk reaction soon thereafter. So that's why timing your rate lock strategy matters. And at Medallion Funds, we monitor bond market movement in real time and not just rate sheets. So what this means for you if you're refinancing? Well, if you're considering refinancing, the point is don't wait for headlines to happen, but watch inflation and wage data trends or hire a mortgage broker that does. But understand that markets move before the Federal Reserve acts too. So many borrowers assume rates drop only when the Federal Reserve cuts rates, but that's not how it works. The mortgage market moves every day up and down. And mortgage rates move based on inflation expectations, as well as bond market activity, but often months before official rate decisions is the point. So let's look at the jobs report and mortgage strategy in the greater Houston area. And for buyers in Houston, Katy, and Fulshire, timing matters, especially in competitive submarkets. So if you're a first-time home buyer or a doctor using a professional loan program or a self-employed borrower who's looking to use bank statements to qualify for a home loan, or even an investor evaluating DSCR options, understanding macro trends is going to improve your strategy is the point. And strong economic data can tighten affordability, whereas weak data can open up opportunity. And the key is preparation. So here's the takeaway for the day. The jobs report doesn't just affect Wall Street, but it directly affects your mortgage payment in your pocketbook. And you cannot control the data release. But what you can control is when you get pre-approved and when you lock in your interest rate. and how much cushion you build into your budget. So working with a mortgage broker who watches capital markets daily is probably a good idea. And if you want clarity, instead of reacting emotionally to headlines, that's where we come in. And in Medallion Funds, we break it down and can translate economic data into real world mortgage strategy. That, my friends, is it for the day. Please visit billrapponline.com to figure out how to get a hold of me. Love to talk to you more in person. Have a good day.